Hey everybody, my name is Justin. Today I'm doing a stock analysis on Lockheed Martin, ticker symbol LMT. So let's get right into this. All right, so the different topics we're going to talk about today is a business overview. We're going to talk about their moat. We're going to talk about management. We're going to talk about financials. I'm going to give you guys a valuation on what I think the company is worth and what I think as far as return on invested capital is going forward, risk associated with the company, and I'll give an overall stock grade for Lockheed Martin right now. All right, let's first talk about the business overview. And I pulled this information from their 10K and other sources. So Lockheed Martin is the largest defense contractor globally and has dominated the Western market for high-end fighter aircraft since being awarded the F-35 program back in 2001. They have different products, including fighter jets like we just talked about, mission systems, helicopters, missile defense, and space systems. Recently, the White House submitted their fiscal year 2022 budget proposal to Congress requesting $715 billion for the Department of Defense. That's an $11 billion increase from the prior year. $12 billion will be allocated to the F-35 program. So that bodes really well for Lockheed Martin going forward. Now, over 80% of the revenue comes from government contracts. In fact, I think it's around 85% in total. Now, they have over $140 billion in backlog. So they have over 2 years worth of contracts already inked in stone over the next 2 years. So that is also very good for Lockheed. They're headquartered in Bethesda, Maryland. They have a $96 billion market cap. They have 114,000 employees, and they've posted about $66 billion in revenue over the last trailing 12 months. All right, now let's talk about their moat. And I think they have a couple of different moats. So first off, I think they have a switching moat. I think it'd be really, really hard for the government to switch contractors, especially for their F-35 program. You know, say they gave it to Boeing or another government contractor. It's probably actually going to cost the government, who's the customer in this case, more money to switch, because that other company's got to figure out how to build fighter jets a certain specific way that the government wants, all the testing that goes into it. So I do think they have a switching moat. I also think they have a secrets moat. They have a lot of different confidential programs. And, you know, not to say that companies can't reverse engineer their fighter jets or other, you know, missile systems or whatever. But again, I think that they have a lot of intellectual property that they own. So they have a lot of secrets there. And then I think their name carries a lot of weight in their industry. I mean, there's a lot of government contracts, or the government actually, before they roll them out, will approach Lockheed and say, hey, just bid for it. And essentially, they know they're going to get it up front, or they know they have a good chance if they do a request for a proposal that they'll end up getting that specific contract. In fact, the company I work for is in the government defensive sector. Lockheed is our largest customer that we deal with, and we have a really good relationship with them. All right, so now let's talk about management. So James Taslet, he is the chairman, he's the president, he's the chief executive officer of Lockheed Martin. He became the chairman in March 2021, so this year, after joining the company as president and CEO in June 2020. He has been a director on the Lockheed Martin board of directors since January 2018. Before that, he was the CEO of American Tower Corporation, and he was also their president. He grew, this is really impressive, he grew the company from about $2 billion at roughly market cap to over $100 billion during his tenure. So very, very impressive there. All right, so now let's talk about financials, and I do a deep dive into this. So I do a 7-year review, so I look back at the last 7 years as a good comparison, and I look at different metrics. So the first set are growth metrics. I look at sales per share, earnings per share, free cash flow per share, book value per share. And I have another set of metrics I like to look at that kind of tell me how well management is effectively running the organization, from return on equity, return on invested capital, and then how much long-term debt they have and how much it would take, or how long it would take them to pay off their long-term debt. So let's take a look at each one of these. And the first one up here is sales per share. So keep in mind, I'm not looking at exactly sales per year. I'm factoring in how many outstanding shares there were with the company. So that's really important looking at this. And look how well it's grown. So you're talking they were at $126 per share back in 2014. It's been just a linear tick up to about 242 the last trailing 12 months. So that is very, very impressive. Let's take a look at the next one. This is earnings per share. That's also a big tick up from, you're talking about $11 back in 2014 to $25 here in the last trailing 12 months. Now look at this right here. So 2017, I dug in to figure out, what's kind of going on here. Why was there a big dip? And I have a note off to the side here, but they discontinued an operation. They wrote it off. So that's why they had a huge dip in earnings for that year. So there's nothing wrong with the company. It was just a one-time write-off, which is creating this dip. But overall, again, we see that linear trajectory just like sales per share. So that is fantastic. Next one is free cash flow per share. So free cash flow is cash from operations minus CapEx or capital expenditures. And again, we're seeing this upward linear movement from about $9 back in 2014 to $18 over the last trailing 12 months. Looks like we had a little dip in 2018, but for the most part, it's just been an upward trajectory. So that looks pretty good, very similar to what we've seen so far. Book value per share, this has also been going up. Now we did see this huge kind of drop off again with that one-time adjustment in 2017, but overall, it's gone from around $10 a share book value all the way up to about $23 a share. And book value is equity, so essentially that is assets minus liabilities. I've talked a lot about that on my channel, so I'm a big advocate for book value. So again, seeing upward trajectory there. So financials look really good overall, despite that one-time write-off in 2017. Now, the next thing I'd like to take a look at are the next metrics, kind of give me a good idea of how well management is effectively running the organization. And the first two we're going to see here is ROIC and ROE. So ROIC, that is return on invested capital. That is net income over total capital. So equity plus debt financing. And that's what this is over here. For me personally, I like to see 10% or more. That tells me that the company is effectively managing the company. So basically every 10 cents that they get from equity or financing, they can turn into net income. If it's over 20%, that's really good. Over 30% is kind of just in a different stratosphere. And you can see they had that 15% back in 2017 with that big dip down with that one-time event. But they've really been in the 30s most of the time, 38%, 20, 33, 15, 32, 39, 35, 38. So most of the time they've been over 30%, which is absolutely incredible. Return on equity is just looking at net income over equity. Again, that big dip in 2017 with that write-off. Then we had some huge increases year prior and year after, but they've been over 100% nonetheless. So that's really good. So that tells me the company's really been able to take equity, shareholder equity, putting into the company and really turn that around and creating net income. So that is great to see. Fantastic. Now, next one I want to take a look at is long-term debt payoff. So essentially, how many years will it take for the company to pay off their long-term debt based on their free cash flow? And for me personally, I like to see less than 3 years. If they can pay off their long-term debt less than 3 years, that gives me a good feeling that the company is financially stable and is in the right place. And for the most part, they've been around 3 or less. So 2014, they were around 2 years. 2015, about 3.5. 2016, 3.5. 2017, 2.6. 2018, we saw that big run up here, which was interesting because we looked at that slide before. Was it this one? They had a big run up here too, which was kind of interesting. I didn't have a chance to dig into the reason for that, but obviously they took on a lot of debt financing, or the free cash flow went down. If we can go back and take a look at free cash flow per share, oh, see, it's free cash flow. So free cash flow dipped in 2018. Again, I didn't take a look at what was going on there, but that would be causing the reason why that debt payoff was bigger that year. 2019 was 2 years, 2020 was 1.8, and then right now they're at 2.3. So they're less than 3 years right now, so that is fantastic. So really, really good overall. Now, if we took a look at a summary for all these, you know, for sales per share, earnings per share, free cash flow per share, book value per share, I want to see at least a 10% annual growth per year for each one of those over the last, 7 years. So you can see they're at, 11%, 13%, 16%. 12%. So they've been over 10% each of those. That's a yes on all these. So you can see yes here, yes here, yes here, yes here. You can see the headers here. I don't know why this says 7 years. It actually should say 5 years. So I need to update that on my spreadsheet. So that is 5 years, just so you know, on both of those. All right, so now the next one we see here is ROE, ROIC, and then debt payoff. So ROE and ROIC, I want to see a 10% average over the last 10 years, and we see 136% for ROE and 30% average over the last 7 years for ROIC. So that is a yes on both of those. So that is fantastic. Debt payoff, we talked about that before. Right now they're at 2.3 years. So that's less than 3 years. So that is fantastic. So that is all looking really, really good. So you can see all 7 were check marked. It's very rare that I find a company that has all 7 check marks. So that is fantastic. All right, let's move on. So let's talk about valuation. So whenever I'm looking at companies, you know, there's the 4 M's I follow, which is very similar to what Phil Town talks about. You got the meaning, which you got to understand the business. We know that Lockheed Martin's a government contractor. 30% of their revenue comes from F-35 sales. 80% of their total dollars come from the government in general. The moat, so they have a secrets moat, they have a brand moat, they have a switching moat. Now we're getting to the margin of safety, which is the valuation, and we've also talked about management. And when I do valuations, there's 4 different valuations that I do. So I do a margin of safety, I do a 10 cap valuation, a discounted cash flow, and I also do an enterprise value to future free cash flow, and kind of see what the buy target prices for each one of these is, and kind of do an average and kind of see where they fall. All right, so the first one we want to take a look at is margin of safety valuation. That's really looking at earnings per share, which we can see here is just around 25. And, you know, I have an average growth over the next 5 years around 12%. And if you're asking, does that seem legit or not? So if we go back and take a look at this, we can see earnings growth over the last 7 years on average has been, 13%. Last 3 years has been 17%. So I think 12% to me is very, very reasonable to do. All right, so I have 12%. And so based on that information, I'm coming at the target buy price of $337. So keep in mind right now, the price is $349. So I think the price is 4% above what my buy price would be based on my margin of safety. Now, if we take a look at the 10 cap valuation, that is essentially looking at free cash flow of the company and then adding in the tax provisions. So that's what this is up here. So we have operating cash flow, minus capex, which gives us free cash flow, adding in the tax provision. So total owner's earnings is about $8.6 billion. There's about 276 million shares outstanding. So I get about $31 of owner's earnings per share. I'm willing to pay 10 times that. So I come to a 10 cap valuation about $313 for Lockheed Martin, which is about 12% below what the stock price is right now based on my 10 cap. All right, take a look at my discounted free cash flow valuation, and this is essentially looking at the company right now projecting out free cash flow over the next 10 years, discounting it back to today's dollars. And when I do that, I get an intrinsic share price of about $364 a share. So it's about a 4% margin of safety. So this is the first valuation we've seen where it actually looks like it would be of good value. And I'm using about $7.2 billion of free cash flow for this upcoming year and then projecting it out from there. And I'm kind of 7.2 billion because that's what they're projecting. These analysts project their Lockheed's going to do this year. So I feel pretty comfortable about using that number. And then if we look at free cash flow to enterprise value, if you don't know, is just like market cap, which is total outstanding shares times the stock price, but then you're also essentially subtracting out cash and then adding in debt to the situation. So I think it's actually a better valuation or better judgment or measurement of a company's value than market cap. All right. So what I do here is I look at the last 5 years, and I take an average of that free cash flow, multiply it by a 20, and then I get and then I add in debt and then subtract out cash. So when I do all that, I come with an enterprise value of 115 billion, and right now it's trading at $105 billion enterprise value. So actually, it's showing, to me, it looks like actually a pretty good deal right now. And so my buy target price would be around $420 based on this particular valuation, which is about 17% margin of safety. So if we look at a summary of all of these, we have margin of safety price of $337, 10 cap price of $313, intrinsic value or discounted cash flow, I get about 365. Now that's, I forgot to mention, that is return on investment of 15%. That's what I'm kind of looking for evaluation. And then free cash flow to enterprise value is 420. So an average of that is $359. And that would only be about 2% margin of safety from where it's trading at right now. Now keep in mind that the current PE is 13. It's at a 13 right now for Lockheed. Historically, they've been around a 16. So even on a PE level too, they're actually trading at a lower valuation than what they historically have been. So it does look like it's trading at a good valuation right now. All right, so now if we go and we look at risk associated with this company. So first off, government relationship, obviously 80-85% of their sales come from government. If that were to go sour one way or another, I think it's very unlikely that would happen since they've been dealing with the government for so many decades and they're the largest government contractor globally. But that is a risk that you should be aware of. F-35 issues, they've had some of those. Keep in mind that's 30% of sales. So they've had some issues over the last year or so with F-35. I think Lockheed will be fine, but they have had some issues there. If they continue that issues, maybe the government pulls contracts from them. I think it's unlikely again, but it could potentially happen. And then political risks, depending, if you have a Republican office, a Democrat office, there's always debate there on how much the government's willing to put in for the Department of Defense. But we just found out that their budget for 2022 is over $700 billion, which is an uptick from 2021. So even having Democrats in the office, let's say, compared to Republicans, they're obviously still valuing the Department of Defense. And so I don't think that's a big issue, but it's still an issue there. And then the fourth one is SpaceX. There is some concern that some of the space contracts that Lockheed Martin has, maybe they might lose some of those to SpaceX. So just keep that in mind. But that is a smaller percentage of their total sales. But it's just something to be, keep in the back of your mind. That is at least. Now let's go over the stock analysis summary. So first off, they have solid financials, really good growth metrics, good management metrics, some of the best I've ever seen, which is really good. They have a really good valuation right now. I think my buy price is actually above what it's trading at by a couple of percent, but it's still there. This company is a very strong share buyback company. They've been buying back shares like every year for the last decade, which is great for shareholders. So each year you're getting a bigger piece of the pie. They also have a dividend of about 3%, which is excellent. The company has a 2-year backlog, which is just tremendous. Again, they had a $140 billion backlog, and they did about $66 billion over the last 12 months of sales. So you're talking over 2 years worth of backlog there. And then they have a really, really good moat with their F-35 and the other government contracts that they have. So I think it's a very attractive company, attractive valuation. So overall, I'm going to give a thumbs up on this company. I think really a thumbs up for me. I would expect to get over a return on investment of 15% or more, and that is not even including share buybacks. That's not including the dividend. That's just looking at the share price itself. So that's a thumbs up. If it was a thumb sideways, that would be between 9 and 14% ROI. If it was a thumbs down, it'd be less than 8% because it'd be worse than the market. But boy, this is really good. This is looking really good. So definitely a thumbs up there. All right, guys, so thank you so much for watching. I really appreciate this. If you enjoyed this video, please hit the like button. Please subscribe if you like this kind of content. This is a new format that I'm using, so let me know if you like this type of presentation, if you want me to keep this going forward. So thank you so much for watching. I really appreciate it. I'll catch you guys on the other side. Take care, and God bless.